Working capital is the amount of funds which are necessary to an organization to continue its ongoing business operations, until the firm is reimbursed through payments for the goods or services it has delivered to its customers. Working capital is measured through the difference between resources in cash or readily convertible into cash, current assets, and cash requirements, current liabilities. As a result, capital resource allocations relating to working capital are always current, that is short-term. In addition to time horizon, working capital management differs from capital budgeting in terms of discounting and profitability considerations. They are also reversible, to some extent. Considerations as to risk appetite and return targets remain identical, although some constraints, such as those imposed by loan covenants, may be more relevant here. The short-term goals of working capital are therefore not approached on the same basis as long-term profitability, and working capital management applies different criteria in allocating resources. The main considerations are 1. Cash flow/liquidity and 2. Profitability/return on capital, of which cash flow is probably the most important. The most widely used measure of cash flow is the net operating cycle, or cash conversion cycle. This represents the time difference between cash payment for raw materials and cash collection for sales. The cash conversion cycle indicates the firm's ability to convert its resources into cash. Because this number effectively corresponds to the time that the firm's cash is tied up in operations and unavailable for other activities, management generally aims at a low net count. Another measure is gross operating cycle, which is the same as net operating cycle except that it does not take into account the creditor's deferral period. In this context, the most useful measure of profitability is return on capital (ROC). The result is shown as a percentage, determined by dividing relevant income for the 12 months by capital employed. Return on equity (ROE) shows this result for the firm's shareholders. As above, firm value is enhanced when, and if, the return on capital exceeds the cost of capital. Guided by the above criteria, management will use a combination of policies and techniques for the management of working capital. These policies aim at managing the current assets, generally cash and cash equivalents, inventories and debtors, and the short-term financing, such that cash flows and returns are acceptable. Cash management. Identify the cash balance which allows for the business to meet day-to-day expenses, but reduces cash holding costs. Inventory management. Identify the level of inventory which allows for uninterrupted production, but reduces the investment in raw materials, and minimizes reordering costs, and hence increases cash flow. Note that inventory is usually the realm of operations management, given the potential impact on cash flow, and on the balance sheet in general. Finance typically gets involved in an oversight or policing way. 714C Supply chain management. Just-in-time (JIT). Economic order quantity (EOQ). Dynamic lot size model. Economic production quantity (EPQ). Economic lot scheduling problem. Inventory control problem. Safety stock. Debtors management. There are two interrelated roles here. Identify the appropriate credit policy, that is credit terms which will attract customers, such that any impact on cash flows and the cash conversion cycle will be offset by increased revenue and hence return on capital, or vice versa. See discounts and allowances. Implement appropriate credit scoring policies and techniques such that the risk of default on any new business is acceptable given these criteria. Short-term financing. Identify the appropriate source of financing. Given the cash conversion cycle, the inventory is ideally financed by credit granted by the supplier. However, it may be necessary to utilize a bank loan or overdraft, or to convert debtors to cash through factoring.